Charlie Aitken is regarded as one of the most listened to and read stock pickers in the country. And he's often considered a very controversial one as well. So what are his controversial calls for 2014 for the stock market and the individual stocks themselves? The controversial Charlie Aitken, welcome to the Switzer program.
I think the term you're looking for is non-consensus, Peter. You don't make any money being consensus. You don't make any money commentating after the fact. You have to make forecasts, and obviously those forecasts hopefully are more right than wrong.
Yes, it's a controversial answer to that controversial
non-consensus. Non-consensus, forward-looking.
Okay, let's start the big picture first, Charlie. What's your view for stocks for 2014?
It's interesting. Look, I think it's more about what you need to avoid, a bit like this year. I think we started this year, Pete, and I said you had to avoid anything that had just been purely supported by the Federal Reserve, which means the Australian dollar, gold, long bonds. The worst asset classes have been the Australian dollar, long bonds and gold, and that continues to this day, even as we speak, as the Fed warms up to just reduce the largesse a little bit. Equities and residential property will continue to perform and be the best asset classes globally and locally. Why? Because they're not as dependent on physical bond buying. At the end of the day, I think equities will benefit. They'll get through this Fed tapering thing because the Fed will be tapering because the economic data is strong enough. That should support equities, and it should support cyclical equities over anything else. So, if anything for 2014, I suppose I have a bit more of a cyclical tilt to the equity portfolios, both domestically and globally, because I think they will lead equity markets from now. But I really do think equities are still the place to be. I cannot see any other asset class that will beat them in a total return sense. Okay,
you've thrown a number out of 6,000. I know your name and 6,000 going side by side. Is that a half-year, a mid-year point or an end-year point for you? It's a mugs game.
No, look, I think
this sort of thing.
Yeah, no, I think sometime in the third quarter of 2014, so it's sort of Augusty, maybe about the full year reporting season in Australia, that the market should see something near 6,000. It's not even a big call, Pete. The market's 5,300 today. Can the index go up 10-ish%? Yes, it can, particularly if resources start leading the market. BHP and those come back to bed.
Throw dividends in. Throw
dividends in. 5% dividend yield or 4.5% dividend yield. Some franking credits to those who can use them. The only thing I would caution on is I think, Australians have got to remember that the world looks at markets and everything in US dollar terms. While the Australian share market's done well this year, in US dollar terms, it's actually down.
Yeah.
So, because the currency's down 15, 20 cents versus US dollar. I think that could happen next year as well. I think the Aussie dollar could head to 80 cents, but the share market could be 6,000, which means in US dollar terms, it's actually gone nowhere. Yeah. You can collect the dividends. But I think that's just something we need to keep an eye on, that we will probably underperform the world in US dollar terms, but also the US dollar the Aussie dollar being at 80 cents is a great thing for the economy.
How do we get to 80, Charlie?
How do we get to 80? Quantitative easing, another cash rate cut. The number of unnatural holders of the Australian dollar is huge. I mean, the currency's 90.23 as we speak. It's lost a cent today just on the GDP data.
But won't some of our stocks lose ground when they're pulling out because they fear that you're right, that the Aussie's going to go to 80?
I think that's already happened, Pete. I think that you've seen the currency come down 20 cents this year. I mean, 2/3 of the currency hit has already happened. The next bit is probably the hardest bit, the last 10 cents. So any foreign investor that was worried about the currency is probably underweight Australian equities anyway. I think the next bit of it is a sort of orderly decline to 80, low 80s. The share market handles it pretty well. Foreign earners get bid up. It's good for resources. It's good for anyone who earns anything in US dollars, and it's obviously good for the broader Australian economy. So
I've always thought of you as a young man, but this year you actually sounded older and wiser in tipping people into dividend stocks. And you actually, when you wrote, it felt your age. I know you're now a father. And that paternalistic line was coming in. Look, I think it was a good play. But are you going to be an old wise man for next year as well?
Well, I mean, listen, in all of investment strategy, you have to be ahead of whatever the next trend is. I thought it was pretty obvious that ultra-low interest rates in the world, quantitative easing and ultra-low interest rates in Australia would see people move out of cash into something that paid some sort of higher income stream. Ignore equity risk premium and just put their money to work. I mean, that happened. It happened globally. I thought it was an easy call. So we did have yield compression. A little bit, I think, of it's structural, though. Australia has an ageing population. We have a trend to self-managed super funds. And we also will have low interest rates, which is a bit cyclical for quite an extended period. So for me, as the population ages and the more people are more interested in certainty of income, I think the value of those stocks with fully franked dividends will continue to be strong.
Definitely.
And I won't be selling them. I think that, will they lead the market in 2014? No. Will they fall apart? Absolutely not. Will they deliver nice total returns to people who hold the Telstras and the banks? Yes, probably not as big as this year. The dividends are physically going up, the franking credits will be there, and there's a chance of special dividends. So they're still part of my model portfolios, but in terms of trying to generate more capital growth, I am tilting them more towards cyclical stocks now. It's time to revisit the big resource stocks. It's time to revisit some of the East Coast cyclicals as a building cycle gets going. And I suppose if I'm talking about the year ahead, it's just a bit more cyclical than defensive, but I don't think the yield stocks are going to fall apart at all.
On your point around structural change, I wrote an article in the Switzer Super Report on smaller companies that have a great history of paying dividends, and a lot of people read them because they're really happy with their dividend result on the biggies, and the smaller one, like Metcash was a classic one, and it did well this week, was quite surprised me in terms of its return, but it's been a good dividend payer, and people are going to look for dividend payers because they know that if a crash comes again, the dividends still keep coming, as long as you can suffer that capital going up and down. That's right, and
I think that also people become very loyal after 5-10 years of dividends from a company, particularly growing dividends. Dividend income investing is not about raw dividends, it's about trying to find stocks that can grow their dividends. So a 3% fully franked yield stock that's growing its dividend is as good an investment as anything. It doesn't have to be 5, 6, 7%. Now, I think the most obvious thing is a bit what I predicted, is that people would go for the obvious names, banks, Wesfarmers, Telstra. That happened this year.
Yep.
I think you're right. I think it can broaden out next year to sort of mid-cap industrial stocks that have a good track record of paying high fully franked dividends that aren't very geared. The key is not to buy stocks that are too geared that pay dividends, because that comes with a risk. And I think you're right. I think as the East Coast economy recovers, that the market will broaden out that theme towards stocks with dividends that aren't the biggest stocks in the market.
Well, funny, when I went...
But actually, can I say one thing? I think that's actually going to also includes BHP, Rio, Fortescue, Woodside. The market is going to actually think about big cap mining and energy stocks for fully franked dividends.
Okay, we showed a chart in this program last week where the top 20 stocks had gone like that, and the small cap index had gone like that. Over 2014, do you think the small cap index will start catching up on the big 20?
Well, that's not quite right, because small cap industrials, if you look at the XSI, which is the small industrials, has done really well. What has made the small ordinaries index so terrible is small resources and mining services stock, which have both gone back to 10-year lows. So the industrials in that index have done really quite well. The resources have done dreadfully. The small resources stocks, I wrote a piece on today, it's just been a disaster. Absolute unmitigated disaster.
So when do we buy mining services companies again?
Mining services, I just think it's over. I think it's...
Until you get another mining
It's an unrepeatable boom of capital investment. I think these companies, no offence to them, are not high barrier to entry companies. I think you're far better off being in a big mining stock like a BHP, Rio, Fortescue, or even Woodside than any mining services stock or any small resource stock. There's a number I wrote today, Pete, which I couldn't even believe I wrote it. There's 1,044 mining and energy stocks listed on the ASX. 1,044. Only 34 of them pay annual dividends, and 15 only pay fully franked dividends. That's after a 10-year mining boom and hundreds of billions of equity raised to bring on new projects. It's an absolute disgrace.
It's quite a telling fact. Now, you're smart enough to work out what's going on in the minds of our wonderful friends, the Lowies. What's going on there for this Westfield play?
Oh, well, I think they're actually, it's quite similar to the strategy we're talking about here. Yeah. I think, they sold out of Westfield Retail Trust in February at 3.09, the shares are 2.99, so it's been reasonable to do what the Lowies do, would have been a reasonable strategy. Moving most of their interest to the probably higher growth US, European and UK assets is smart. Aussie dollar's coming down. My advice to people today was, look, I just do what the Lowies are doing. If all their money's in WDC, your money should be in WDC. If they have no money in WRT, don't have any money in WRT. Simple as that. It's a bit like following Packer this year has been great in Crown, or following Forrest in Fortescue. You put your money where their money is. So the Lowies are very smart people. There's nothing wrong with what they're doing, but my money would follow them into into the foreign one.
It's very hard to work out.
You don't have to overcomplicate it. If the Lowies is good enough for the Lowies' money, that's where mine will go.
So WDC is the one you go
I would strongly favour WDC over WRT, and you saw today in the share market, WDC was up about 3 and a bit %, WRT down a fraction. I think that's the right reaction.
OK, what about Dick Smith? What's going on there?
Well,
20 million to what, 400 million?
I know, and then opened supposedly this massively oversubscribed deal that closed flat today. So I don't know, Pete. I just struggle with that a little bit, that you can turn 20 into 400 in a year. And I see, I'm just still scarred by what happened at Myer. And, it's too easy to turn some of these things around, redo the inventory, get some cost out and sell them back to the market. Look, personally, paying a 1 PE premium for JB Hi-Fi, an established company with a 20 ROE and a rising dividend yield, I think I'd prefer to do that. And, JB Hi-Fi looked a little bit expensive previously versus Dick Smith. Now, it looks actually quite cheap. So I don't know enough about Dick Smith, but I just don't really like being the patsy buying from private equity. I mean, so much money was made in such quick time. I think that I would rather buy an existing stock that looks cheap versus that.
Yeah, and on 9, you made an interesting point. You said, what was it about bet the Packers?
Well, I think they said there's only 3 people who've ever made money out of Channel 9, Frank, Kerry and James Packer.
All Packers.
Yeah, they're all Packers. And I mean, that is actually a statement of fact. So I see the deal went off today at the bottom end of the range at 205. It will list. I mean, I just can't get excited about free-to-air TV. I mean,
a lot of challenges, isn't it?
A lot of challenges. A lot of challenges from the internet, cable TV, even this program. Just not for me, that one. I think there's so much choice in the equity market. You don't have to be involved in everything, particularly something that pretty much almost went broke a year ago.
Okay, one last question to you. Tell me the wind-up by ignoring them. The bull market, how long do you reckon it's got to go?
Cycles are generally 7 years, in my view, and I think we had a 5 or 6 year down market. We're a year and a half into an up market. I mean, I so strongly believe that saying that bull markets are born of pessimism, grow on scepticism, mature on optimism, peak on euphoria. Right. I think we're somewhere in the grow on scepticism, mature on optimism stage of this. Yep. There's still a lot of scepticism, Pete. Even me saying I think the market can go to 6,000, which is a nothing call. Yeah, it just gets, do you really think that could happen? Remember a year ago, I think I said that's the end of the bear market. People are like, you can't be serious. We're still in that grow on scepticism phase. There's still a mountain of cash sitting on the sideline earning nothing real. Yep. Interest rates are going to stay low. The economy is getting better. Don't look backwards at the GDP data today. That's from 3 months ago. The economy's getting better. The world's getting better. And I think there's many, many years of this to go.
Thank God you're saying that, Charlie. Good to see you. Have a good Christmas.
Thanks, Pete. Thanks for having me.
If you want to read Charlie, he's in the Switzer Super Report and he has his own newsletter as well. After the break, our regular public defender, John Rolfe, will tell us which businesses are behaving badly.